Thank you, everybody. I think I'm a little bit biased here in relation to the subject matter that we're speaking about today. I can tell you outside of Australia, across Asia, in my time in the UK and Europe, conversations about compliance and data and running a business with the context of having to change the way you operate very frequently the subject matter is the subject matter that tends to consume people's lives. And so I'm very lucky to have 4 incredible panelists who bring a very different view, each of them, to this subject matter. Some of whom are focusing on compliance, some of whom are focusing on business, and it'll be interesting to hear from each of them the way they're tackling these problems, given I think the whipsaw approaches that different jurisdictions are using in relation to this subject matter. So I'll just quickly get everyone just to say the name of the organisation. No, it's on there if there's any sort of quick observation, but I'll start at the end.
Hi, my name is Ambre. I'm the CEO of Kaiko, and we are a global company providing market data, analytics, and indices in the cryptocurrency and digital asset space.
Raj Mukherjee. I'm the CEO of Bowden Advisory, a consulting firm for regulatory and tax areas of blockchain, but till recently I was the head of Office of Digital Assets for the Treasury Department.
Hi, Roshan Robert. I'm the US CEO of OKX. We are a global exchange.
I'm Michelle O'Connor. I lead global expansion and innovation at Taxbit, and we're a global financial compliance solution.
So very different lenses. I'll start with a practical sort of observation and question for you, Roshan. It's expensive to do what you're planning to do. So this is the business side for us. You're I think, now in charge of a very rapid expansion into the US. Speak to me about the expense and the complexity of trying to build out what you're building out.
That's a great question. It is a complex business, right? 90% of, when you're trying to build finance on public blockchains, 90% of this is about technology. It's about the architecture. It's about how we build, how we build the architecture to connect across over 100 blockchains. What we've done is, over the last few years, we've decided to take that infrastructure that we've built and place it on the 5 pillars of finance. So we built out a robust compliance framework. We built out a proper risk management program. We brought together all the client money controls to have a proper governance around it. We've instilled a robust cybersecurity framework. And last but not the least, we've got the sales practices sorted out. We've really have a supervisory mechanism over the sales practices that we have. So essentially, we've brought that flavor of TradFi into crypto. And I think that's the way to go as we move towards a more robust regulatory environment.
Amber, have we started did we start at the right spot? I mean, from your perspective, when it comes to data, and regulated data, which is where we are, where do we start? Did we just start in the wrong spot in terms of what you're seeing now, in terms of the way you operate your business? What sort of changed from 10 years ago when you had the plan and the vision for how important data would be in this sector?
I don't know if we did I think the beginning 10 years ago was just extremely retail. Just crypto as an asset class and as an industry was very retail, and so the focus on data was less important. People bought because they had a conviction and they just wanted to participate in the asset class without really trying to take a kind of a data-driven approach. We've built all of our data solutions focusing on financial institutions, thinking there would be a kind of 2-step development of the industry. The first one being crypto as an investable asset class for financial institutions, and thereby the asset class requiring financial data services on par with what you have for traditional asset classes. So that was the kind of, I would say, first stage of development of Kaiko's offering. And this was very important because it brings transparency, it brings trust in the markets. It's important also from a regulatory standpoint to be able to do market surveillance, to be able to understand market microstructures, order book, market depth, liquidity, etc. And these are things that were not necessarily appreciated by a retail audience, but as the industry became more sophisticated, sophisticated and the participants more sophisticated, understanding things like market structure and liquidity risk was actually critical, and this is what we provided. Now I think we're entering into a second phase of development of the industry, which is more around using blockchain as an underlying infrastructure to enable operational efficiency and just more TradFi workflows that could be done differently on chain. And if you believe in that, and I think everybody here does, that's why we talk so much about stablecoins and tokenization. If you do believe in bringing more operational efficiency using blockchain to execute workflows, actually data becomes increasingly critical, because data is not just a reference point anymore. Data is already critical in TradFi, but if you believe in the fact that now you're going to have automated processes and workflows, the data is not just a reference point, but is a catalyst for the execution of disintermediated execution. And so it becomes increasingly critical to have reliable, trusted data that is independent and neutral versus the applications they power. And that's really our kind of our DNA and our positioning with Kaiko, is to say we're a completely neutral third party to all of the strategic interests in the industry, but we're here to provide an independent source of truth. And that's the second interesting development I think we're seeing now happening.
And a follow on then, when was that moment, when did people have the epiphany that this is an efficiency opportunity for them? Because people disregarded the technology for a number of years. They thought it wouldn't. Fundamentally looking at cryptocurrency and saying it won't scale, this is a bit of a nullity. When did the penny drop? Or for some people, has the penny dropped?
I think it happened a couple of years ago, but we're talking about big institutions that, you know, don't have an incentive to take a risk of breaking something that works for the sake of making it marginally better. And I think that is that definition of how marginally is marginally, right? I think now we're realizing that the operational efficiencies and cost-cutting opportunities are actually bigger than expected, and everybody's now taking this very seriously. But for me, it's more about it's like an OPEX opportunity more than it is a liquidity opportunity. And that I think is, has become much more meaningful at the institutional level over the past year or so.
Raj, you were in the private sector at Consensus, and then you joined the public sector, and now you're back in the private sector. In every jurisdiction I'm in, people always talk about regulatory clarity. We're after regulatory clarity. All we need is regulatory clarity. Did your view of what regulatory clarity was change when you were in the private sector and in the public sector? How do you sort of view what that aspiration is and what ultimately means?
Yeah, that's a really interesting question. I think I underestimated the challenge that regulators have in creating regulation for a technology-driven industry that will always move faster than regulation can keep up. I think I'll pick up on a couple of things. So I think rulemaking is very difficult because as a regulator, you are focused on the 80-20 proposition. You have to make the rules for what is the proliferation sector of any industry. So you always run the risk of either being accused of making it too general or too vague or too specific and too outdated. But one of the things that you said that actually resonated with me is that a lot of the conversation was around data as well. What is the data you need to collect? What is the data that's permissible to be collected? And what is the purpose of collecting data? Because at any given point in time, as a regulator, you have to justify why you are collecting the data that you're collecting, especially when it comes to people's privacy and financial information, right? And I think the challenge that I think other folks have talked about earlier today is that traditional financial principles of intermediaries and linear relationships between agents and agencies don't really work in this sector. So, as a former regulator in the Treasury and as co-author of the now infamous digital asset broker regs, I'll tell you that the first half was easier. The custodial broker regs were easier because in many cases, the majority of people that invest in sort of Bitcoin and Ethereum through the Coinbases or the Krakens or Geminis of the world, they're not all that dissimilar to investing through Charles Schwab. The operations look the same. They have the same KYC. DeFi is a whole nother world, right? And we always knew that it was going to be in the least challenging, because the way DeFi works and the way these transactions work do not fit that traditional agent-agency relationship. So I think, look, I've had the opportunity of seeing this from both sides. I was actually co-author of the consensus comment letter to Treasury, so I found myself in very interesting situations when we were talking about DeFi regulations within Treasury and of pointing out certain paragraphs that I pointed out. But I do have an appreciation of the difficulty that regulators have in this sector of trying to imagine something that will fit, that is fit for purpose, but also future-proof.
Who do you have
and Raj, and now the OKXs of the world as well.
Yes, well, there's that.
Who do you have more sympathy for at this point in time, Raj? Do you feel worse for industry, or do you feel worse for the regulators?
So I think the challenges are different. Look, I mean, part of the reason I joined the public sector and joined to head the digital asset offices, I felt like at the time, with the best intentions, the industry and the regulators were speaking past each other. I do think there's still some of that happening. I think that I was observing throughout today that there was a lot of conversation about, connecting with the regulators, but again, it seems to be a very sort of like siloed and linear relationship. I think what needs to happen in language that people here understand, it needs to be more stacked, right? I think regulations will change and need to change as products are ideated and brought to market, and it has to be an iterative process. So I have different types of sympathies for different sectors. I will tell you, at the risk of sounding too empathetic towards regulators, what would be really helpful when industry or sectors of industry come and talk to regulators, to highlight what would work in addition to what is not working. Because without the public-private partnership, you're not going to have any sandbox that works on either side.
Michelle, I've deliberately left you for fourth because you just need to deliver a product that meets all of these sort of criteria. We have businesses like Roshan's who produce enormous amounts of data that ultimately regulators need to synthesize and get across, and then they say, just make sure it works. Have people come to sense that this is an opportunity now? Is there an advantage now that some businesses are recognising the compliance as an advantage? How are you sort of viewing the way businesses are viewing this sort of obligations?
So OKX is one of our clients, so we're helping them. And I think one of the challenges that companies face is, especially when they're looking at a global scale, is complying with what happens in the US can be very different. And in real time, there is a compliance timeline over the next 2 years where it seems that every jurisdiction got together and said, let's give regulatory clarity within the next 12 to 24 months, and everyone has to comply. That's really hard, especially for businesses that are operating in different sectors, trying to figure out how does their global go-to-market approach look like, and what does that ensure they're compliant, they work within the regulatory system, they have partners like us who can say, this is what it looks like, this is how you comply. And these are the considerations of when you're going to market, the trade-offs. Is this a now? Is this a nice to have? Is this a need to have? And then how do you ensure the UX for the end users is viable, enjoyable, and the end users want to get on, because if you can't make it work for the end users, it won't work for the enterprise. We also work with regulatory bodies who I can't name because they're regulatory bodies. We bridge a lot of those conversations publicly and then behind the scenes to help educate, understand, and go between industry and private sector or public sector.
Michelle, on that front, the amount of knowledge that an organisation like yours has to have is exponentially more difficult, because you're talking to jurisdictions where people, their own jurisdiction effectively feels like their entire world. How does a business like yours manage the fact that so many jurisdictions view their own challenges as a global kind of challenge?
Our team is amazing. We are all very active. We all get very excited about certain jurisdictions. We have working groups within our company who focus on jurisdictions because I lead global expansion. I am over all of it, but it's very interesting because what we're seeing is a competitive race, for lack of a better phrase, where different countries are using regulations as an advantage or compliance as a competitive advantage, where if regulatory comes out, they see enterprises rushing to that area because they know how to go to market and open to retail users. So our company really works on driving thought leadership, helping enterprises understand, helping regulators understand, and then it is a 24/7 moment, because every time you think, oh, this is where it's at, there's an evolution, an adoption, an asterisk, or a change.
It sounds like it'll cost more there too. That's what we should do. Just charge a little bit more every time someone changes the rules. Roshan, is this possible to build and have some confidence? Are you building an engineering marvel here to accommodate these things? You know, you're constantly having to give consideration to rules which are either not set or, if they're set, might change. You know, what's that challenge look like for you?
Well, there's a central premise around why and how an ideal regulatory structure should look like, right? It's a balancing act. It has to balance between investor protection and preventing bad actors from coming into the market. To, on the other side, you have to look at financial inclusion, especially when you're looking at finance on the public blockchain. It's an entirely new technology. You want to make sure that more and more Americans and more people around the world are involved in this process, right? And you want to promote innovation, right? So it's a hard balance, actually, that regulators have to play. And getting that right is so important to the ecosystem, right? But essentially, when you build an exchange or when you build a business in crypto, in digital markets, you are looking at those foundational principles. And you're looking at those foundational principles and saying, all right, this is 90% of this is technology. It is technology that cuts across blockchain architecture, cuts across cryptography, cuts across consensus methodologies, and we've spent 10 years in architecturing this. And when you want to sort of really release that to the world, you want to do it with proper compliance procedures, and that takes time and money to build. We have, over the last 2 years, we've built out a compliance program. We have over 500 people in compliance around the world. We've built out a proper risk management program, and that's also very important because you have to look at the various risks of the ecosystem. It's not just digital assets, whatever people may say, there's a cash component and a digital asset component. So you have to look at risks across the ecosystem. It could be financial risk, non-financial risk, vendor risk. You have to have a framework around that. It has to be a proper risk framework that is managed and monitored on a day-to-day basis. And the last financial crisis has told us that client money controls are very important, right? So we are spending time, money, and effort in making sure that those controls are properly managed. You want to make sure that you have a clear picture and clear segregation of client money, both on the wallet side as well as on the cash side, and you have to be able to account for it. You have to make sure that the way the data flows through through the blockchain and into our data lakes, and from our data lakes into our subledger, and from the subledger into the general ledger, these are all properly managed, right? And cybersecurity, one can't, that is the biggest risk you have to manage in this space. And it is not just about building a cybersecurity framework and making sure that the policy aligns to whatever the latest framework is, which is NIST CSF 2.0, I believe. It's more than that. It is about how you operate the machine on a day-to-day basis. how comfortable are you that your systems are actually monitoring all the endpoints? And how are you governing it day to day? How are you ensuring that risks and threats are escalated to you? And how are you proactively managing that? So how you operate the system in a disciplined, regimented fashion is also important in building a business of this magnitude.
Often it's the case we have regulators trying to catch up. We think a lot of these technologies are rapidly accelerating. Ambre, I'm interested to know the way you're seeing things. You're looking to unlock sort of potential use cases for data, create new products, facilitate new products. One of the things that I think is not particularly well understood outside of digital asset sectors is oracles and sort of the role that oracles are playing potentially then as a bridge. And general observations as to where you think the data opportunities are going. Interested to hear your thoughts on oracles and sort of their role and the role they can and should be playing, and what products you think are on the roadmap that people will soon realise all this data will potentially unlock.
Yeah. So maybe just on the first part, what you said around financial products, data that is embedded inside financial products is critical and is regulated. And I think it's an important part of the kind of growth of the crypto as an asset class. If you think about ETFs or ETPs, or even regulated derivatives, all of that are synthetic products that bring liquidity to the asset class. Those have to be kind of benchmarked by regulated market data feeds. And I think this is an important area of crypto data and regulation overlapping, which is you need to have a data provider that is regulated under specific rules as soon as the data they administer is used for creating financial products. And so that ensures integrity on how the data is used, and it ensures that whatever assets are embedded into financial products are liquid enough to be replicable, and there's a bunch of rules around how you build those things. And I think that's a really important development. Obviously, ETFs they've exploded in the past year, but still relatively new in the US. ETPs in Europe have been around now for more than 10 years, but had much shallower AUMs, and we're seeing that part of the industry grow significantly. So that is more embedding crypto into traditional wrappers. And now to your question around the other side of the spectrum, which is more bringing traditional applications on crypto, right? And so the role of oracles, or the role of kind of on-chain data providers here, is about catalyzing the execution of DeFi applications on-chain. One very straightforward example is if you're thinking about a lending and borrowing DeFi protocol, you're going to send collateral, whatever stablecoin eligible, whatever token eligible as collateral, and you're going to extract stablecoin, and then you'll have a smart contract that continuously monitors the loan to value, and then you either have to post more collateral, or you can get liquidated, etc. So liquidation events are relatively unpleasant events in the world of DeFi, and those events depend on the valuation of the collateral, which in itself depends on the price that an oracle is going to provide on chain for the smart contract to consume, and that oracle itself relies on an input from a data provider that will provide these data. So there's really a kind of a value chain of different market infrastructure providers. There's the pure data component, which is really what we do. Then you have the oracle component, which is more about the infrastructure, kind of publishing the price on chain. And then you have the smart contract that consumes it to potentially execute some action if needed. And I think that this is really a critical part of market infrastructure. We see that on DeFi, and we see how that works on DeFi. And for me, it's just an incredible sandbox to see the potential of using blockchain as an infrastructure for institutional DeFi application, right? Today we're taking examples on, an AVE collateralized loan where you place whatever token and get stable. But in the future, you could have the same thing with tokenized, natively kind of issued tokenized securities and still benefit from the same operational workflow, relying on less intermediaries and less intermediated processes.
And in a relative sense, behind the curtain, in front of the curtain, people talk about capabilities and understanding and They often talk about what their businesses are doing. I think often it's very different once you pull that curtain closed and you see capability not quite what people would suggest. In a relative sense, Ambre, how much do you think that conversation has accelerated? The kinds of things that you just articulated in the last year or two, is there a really significant, is it a multiple 5x, 10x, or is it sort of accretive? How do you benchmark where we are relative to where we were a couple of years ago?
I think we're at the 0 to 1 phase, where we are now seeing really, kind of discussions around natively issuing tokenized securities, not just a wrapper on top, like I would say the early days of tokenization was more taking something that exists in TradFi and then wrapping it into a kind of on-chain token. Now we're seeing institutions really, considering issuing natively tokens directly on networks, and then use the network for the infrastructure feature. And I think we're seeing now taking a bit the best of TradFi when it comes to the ability to securitize instruments, the ability to have financial products and financial applications, but doing it in a much more efficient way. And I really think we're at the inflection point since the beginning of the year of seeing, real life-size institutional applications for that.
Raj, if we're at that inflection point and you put the hat back on, that was the regulatory hat that you wore for a period of time, what are you looking for? What development is it? Is it something which has a very big macro effect, something like stable, the genius stuff, or is it something else? What are you looking at that will sort of signal we've arrived at this promised land that many of us have been speaking about for a long period of time?
So I'll talk about something that no one wants to talk about, which is tax.
Yay!
But it's a factor, right? I mean, it's a bigger factor than we give it credit, and I think that there are some seismic shifts in the regulatory landscape when it comes to what happens to income. And we can go into a different sort of look. I'm a legal nerd, so I can go into conversations about what's income and what's constructive receipt and all of that stuff. But laying that aside, I think if you ask the everyday person, they want to know if their involvement in this whole ecosystem leads to a better financial result for them, and then that usually ties them to some kind of a tax effect. And you've seen a spectrum of appetite in terms of tax regulations around the world. I think Michelle and I have had many conversations in the past about sort of, where we were in the United States with even a year ago or 2 years ago when I joined the Treasury Department in terms of tax regulations and what we were looking at there to what we have now under the new administration. And then on the other side of the Atlantic, you have things like MiCA and CARF that are, if seen through our newly formed deregulatory lens in the United States, it's very restrictive for business and consumers. So I think at the end of the day, I think even when we think of securitizing or tokenizing assets, right, there are some very interesting conversations about commercial law and tax issues and property rights issues, especially when we talk about RWA tokenization. So I think when I look at the plethora of regulations that's happening, and yes, the Genius Act is very important. I think stablecoins are the way to go. They're sort of controversially the new fiat in my mind, but it should be that way. But I also think that we should pay attention to what the ultimate micro level effect it's going to have on consumers, and beyond the technology and beyond the marvels of blockchain, which I really believe in. I think we have to bring it down to what is the proliferation, and for an everyday person that, look, at the end of the day, I think the promise of blockchain and crypto was to break down barriers and to financial inclusivity that you talked about, Roshan, but it's also about proliferation. I keep coming back to that. It's the 80-20 rule. Do people on a regular basis around the world, do they have access to this? How can they use it? How can they financially benefit from it? And what do they have to pay back to the government as a result of that income, right? And I think so we definitely have to pay attention to that.
Michelle, closing out then, because convergence has arrived. I can't believe we've barely heard the word stablecoin uttered. I said across 4 different cities last month, it was all stablecoins all the time. What are you seeing in that regard? Is that the convergence point? People can get around the fact that stablecoins make sense to TradFi businesses, they make sense to crypto natives. Is that the sort of the pivot point, do you think? Is that what you're seeing?
We have less than a minute, so really quickly, the definition of stablecoin is a challenge globally. So what is a stablecoin? we don't have time for that, but put a pin in it because I think that's really important. I've used stablecoins, have seen the industry and traditional finance as well as other family offices. Stablecoins are their bridge where it's their toe into the pool. So they've been watching this space. I've been in it for 11 plus years, building on it, but not going public with it. Stablecoins are very easy to understand for people who otherwise, if you say Bitcoin, they get uncomfortable. But if you say stablecoin, suddenly, oh great, it's just a digitized dollar. Well, is it? You know, it's the comfortable place for people to get in and dip their toe. And then from there, it's who's doing what with it. And that's really where I think the industry from the native cryptos are welcoming others. So I view it as the bridge.
Perfectly timed.
Yes.
Round of applause. Thanks, everybody. Thank you to the speakers today.